All right, let's go ahead and finish up our videos on depreciation for the week. We are in luxury autos. Special rules apply to luxury autos. Congress, IRS didn't want people spending these luxurious amounts on vehicles and then depreciating them. So the rules are a little more stringent. Depreciation is limited every year. All costs is recovered, but it's over a longer period of time, so you don't get to recognize a greater benefit year over year. It's spread out. Steps in calculating the luxury auto depreciation. You calculate depreciation using the maker's table, compare the limitation amounts, and then it's the lesser of the one or the two. If auto is not 100% business use, then the limitation amounts are multiplied by the percentage of business use and compared to calculated maintenance depreciation. Bonus depreciation may impact the limitation amount. Lower amount depreciation deduction, higher amount a reduction in the taxpayer's basis of the asset. Lease payments are generally deductible to the extent of business use percent, but there's some calculations that go along with that. But the deduction amount must be decreased by the inclusion amount from an IRS table. This is a headache to calculate. I've done it before. Lease payments are on non-luxury autos are generally fully deductible to the extent of business use percent. So if it's not luxury, then you get to recognize your full lease payment up to your business use percentage. Trucks and SUVs, generally, they're not subject to those luxury auto limitations. So therefore, you can elect 179 depreciate without any limitations. Must be built on a truck chassis and weigh over 6,000 pounds. That's a big question as a tax preparer. You typically ask people. They say, hey, you know what? I'm looking at purchasing a vehicle and I want to know how much 179 I can take on it. You almost always ask, is it over 6,000 pounds? Because if it's not, then your luxury auto limits are going to apply. And SUVs are limited to 28,900 and meet expense under 179. So you can't take 100% of it, but you can take up to the 28,000. Vehicle cannot be used for personal use. Luxury limits do not apply, and vehicles under the 6,000 pounds but built on truck chassis will have higher limitations than luxury auto. Okay, now we're getting into intangibles. So you've got goodwill, that's section 197, computer software, organizational expenditures, section 248, research and issue R&D, research and experimental expenditures. I'm guessing it's supposed to be startup, and then pollution control facilities. Similar to depreciation, but again, different rules, but the same general concept. You're recognizing the cost over a period of time. There is no 179 with intangibles, so it's typically using straight line. So you can't play around with this. So amortizable over 15 years using the straight line method, starting with the month of acquisition. 197 applies to intangibles that are required when created. And it's treated as section 1231 property if it's held greater than 1 year, and that's subject to 1225 recapture. I'm not going to get so far into that, but know that you have to recognize some recapture if you dispose of it. No loss recognized upon sale of one intangible if some or all of other intangibles acquired at the same time are so being held. Bases of retained intangibles are increased by disallowed loss. So here we got some examples. Goodwill and going concern, that's a big one. Customer list, suppliers, information based. Stop kicking my heels, the camera stop shaking. Licenses or permits granted by the government, covenants not to compete, non-compete clause. Franchises, trademarks, and trade names. Goodwill is kind of the one you see a lot of. Customer lists, I see. But the reason why goodwill is such a big one, if I purchase assets from a business for $100,000, and these assets are actually valued at 50,000, I've got 50,000 of goodwill. That 100,000 has to be fully accounted for. Everything that's over the asset purchase, that's goodwill. So this used to be research and development. Now it's research and experimental expenditures, also subject to amortized costs. Includes experimental and lab costs incidental to the development of a product, possible tax treatments, expense in year paid, capitalize and amortize over 60 months, capitalize and write off only when project is abandoned and becomes worthless. So I'll give you some example on this. So before I started preparing taxes, I used to run a lab up in northern Minnesota on the Iron Range for a steel foundry. And we made stuff for the mines. We made these grades. And we would often try out different processes. We see if we can make something more efficient, do something that no one's really done before. That would be subject to the R&D or R&D. But to do that, like I would have to capture all the costs that I had associated with it, cost of materials, and then you would amortize that over the 5 years, 60 months. Computer software, if you internally develop it, you would expense that, or you could capitalize and amortize it over 60 months. But again, time value money, you're probably going to expense it. Purchase software, you depreciate that straight line over 36 months. And if it's part of a hardware purchase, that's 5 years maker. Lease or license software, deductible in full in the year paid. So if you're borrowing it, that's a deduction. If you're purchasing it, you depreciate it straight line over 36 months. Depletion, intangible drilling, developmental costs. This one gets to be a little bit weird, and you're not going to see it a whole lot unless you're kind of specifically working in the gas and oil industry. But let's get into it. Capitalizing expense through depletion, so that gets back in the earlier slide, it kind of talked about units. That refers to depletion. So capitalizing expense through depletion, either cost or a percentage method, you're going to take the bigger of the two, and you can change that each year. You're not set in to whatever year you select it. You get to decide which one you want to take each. So elect to either capitalize or immediately expense, and that's intangible drilling and developmental costs. Depreciate tangible asset costs, right? It's tangible asset. And operating costs during production, those are deducted as ordinary and necessary business expenses under section 162. So here we have an example. So in the current year, Carmen acquires $400,000 in oil and gas property interest, 200,000 barrels of estimated recoverable oil. During the year, 10,000 barrels of oil are sold for 250,000. Intangible drilling and developmental costs amount to 100,000 and are expensed in the current year. Other expenses are $50,000. Cost of completion is $20,000. That's the 10,000 barrels sold times the 400,000 divided by the estimated barrels. That's the units of production. So the computation percentage depletion is as follows. So I'll let you go through all this, but understand that depletion, you're getting into units of production. So tax planning considerations, you've got the alternate depreciation system, employs straight line method. If the income is low now and expected to be higher later, taking the ATS can give a bigger deduction. You don't see it a lot, but again, sometimes you're forecasting and oh man, 3 years from now, you're going to have a big, big year. Maybe I want to take ADS and not recognize all these depreciation expense up front. You don't see it a whole lot because you can carry forward depreciation expenses. Not 170, well, 179 you can, but not. Yeah. So if you don't really ever see it because excess costs can carry forward. Business combinations, separately stating asset prices on a business combination or purchase can restart depreciation, establish book value. Buyer and seller must use the same sales prices. That one you would see. And if maker's life is longer than the actual expected life of the asset, units of production may be better to reflect the actual life of an asset. You don't see that one a whole lot. Units of production, you can use it, but it requires more calculations involved with it. And typically, people would be using 179 or bonus depreciation on that anyways. So it's really, you're weighing the pros and cons, right? There's the time value of money. An expense I get to recognize today is generally going to be better than one I get to recognize 5 years from now. But it's also, if in 5 years from now, I think I'm going to have a lot more income, then maybe I want to hold off on recognizing some of these costs now and wait till further down the line when I think I'm going to be, really, really up there with net income. But generally, you want to take it. Yeah. So 4562, that's where you document your depreciation and amortization. All right, and that is it for chapter 10, depreciation. Again, we didn't get too far into a lot of this. We barely kind of hit on bonus depreciation. Minnesota recognizes that over 5 years. So for federal, yeah, you would recognize 80% of it, and you got to add 20% back. Minnesota is kind of the opposite. You got to add 20% back over 5 years. Understand that 179 is one of your best friends. Bonus depreciation is going to be a close second. And you want to weigh the pros and cons of recognizing depreciation costs today. Generally, it's going to be better to recognize it today, not always the case. So that is it for Unit 10. All right, thanks everyone.